Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly thoroughly revise the income from house property chapter for CA Intermediate Income Tax Examination. And as usual, my humble request to you is to like this video and subscribe this channel because I will be motivated to keep on posting videos like this. Now coming to the subject, I usually tell my students that income from house property and set off and carry forward are two chapters where the theory will seem very simple, but when you are actually solving the questions only, you will know the practical difficulty. So as soon as you are finishing this video, go to the study material, solve all the questions, and then you will be thorough for the examination. Now coming to the chapter, like any other head of income, even for house property, there is a charging section and there is a computation section. The charging section is section 22, which says that for income from house property to arise, there should be a house property, the assessee should be the owner of the house property, and the property should not be used for assessee's own business or profession. Okay, so from this, I want to clarify 2 points for you. Number one, if the property is used for assessee's own business or own profession, then you ignore such property. And number two, if the assessee's business itself is giving house property on rent, then it will be covered under PGBP chapter kana, not under house property chapter. Fine? Okay. Now let us discuss what is house property. House property means building or land appurtenant thereto. Building means permanent structure. Land appurtenant means land or facilities or features that are attached to the building. For example, parking lot, swimming pool, garden, statues, etc. All these are land appurtenant. Now what are the types of house property? There are two major types kana. LOP, SOP. LOP means let out property. It means the property that has been given on rent. And SOP means self-occupied property. Self-occupied property means property in which the assessee himself is residing, or he is not able to reside because he is living in some other city in a property which does not belong to him. So this is self-occupied property. In income tax, up to 2 self-occupied properties are fully exempt, no problem. But if a assessee is having more than 2 self-occupied properties, then any 2 can be claimed as exempt and the remaining will become DLOP, that is deemed to be let out property. This deemed to be let out property brings a notional income concept in income tax. It means what? Even though the assessee has not given that property on rent, still a notional rent will be calculated and tax will be charged on such rent. That also we will see how to calculate. Okay. Now, sir, what if house property is outside India? If house property is outside India, then for resident, ordinarily resident, the rent is fully taxable because global income is taxable. For RNOR and NR, that is resident, not ordinarily resident and non-resident, the rent will be taxable only if it is received in India. Okay. Now, owner. Sir, who is the owner? The owner is the person who is entitled to receive the income from property. So if I am having the right to receive the income, then I only will be considered as owner. Number 2, it includes deemed owner under section 27, which we are going to discuss in some time. Next, registration of sale deed is not compulsory. So it is not necessary that sale deed should be there. Then only I will be considered as owner. It is not compulsory. Next, sir, what if owner of building and owner of land are two separate people? Then you only focus on owner of building kana, because that is building is only house property. Next, what if there is a disputed property? There is a confusion as to who is the owner of the property. In such case, income tax department will decide the owner. And ownership should be in the previous year, need not be there in the assessment year. Means when I am receiving the rent, at that time I am the owner, it is enough. Later on, if I am not the owner, it is not a problem. Okay. Then exception of ownership is arrears of rent and unrealized rent. This I will be discussing along with arrear and unrealized concept. Now let's come to deemed owner concept. Section 27 gives 6 points of deemed ownership. Point number 1. If a person transfers the house property to spouse. Spouse means what? Husband or wife. Okay, without consideration or for inadequate consideration, then the transferor will be considered as deemed owner of the property. But however, there is an exception where there is agreement to live apart, then this provision will not apply. For example, if I transfer my house property to my wife without consideration or for inadequate consideration, then also I will only be considered as deemed owner of the property. But if me and my wife are having an official agreement to live separately, in such case this provision will not apply. Next, transfer to a minor child without or for inadequate consideration. So if I am transferring my property to my minor child without consideration or for inadequate consideration, then also I will only be considered as deemed owner of the property. Okay, here also there is an exception, minor married daughter. If property is transferred to minor married daughter, then this concept will not apply. Next, holder of impartible estate. So, for example, there are two people kanna, A and B. They both are jointly owning a property, but both do not know what is their share in the property. Hence, both A and B together will be considered as association of person. This association of person will be the deemed owner of the property and tax should be paid by the AOP. You get my point? Next, members of cooperative society, company, etc. Sometimes what happens, Nokana, there is an apartment or housing society where there are many flats. This flat is generally in the name of a company. Okay, all the flats are in the name of the company and the people who are shareholders of the flat are only the people who are living in the flat. Hence, the people who are shareholder will be considered as deemed owner. Okay, so the shareholders of the company, or if it is a cooperative society, then the members of the cooperative society will be considered as deemed owner of the property. Next, if the possession of the property is transferred to another person, then also the person who is receiving the possession will be considered as deemed owner if three conditions are satisfied as per Transfer of Property Act, TOPA. So what are the three conditions? Possession is transferred. Number 2, sale consideration is paid or promised to be paid. And number 3, even though sale deed is not executed, some other document should be executed. Okay, so if these three conditions are satisfied, if someone is giving me the possession of their property, I will become the deemed owner of the property. Okay, next, right to property for at least 12 years. So for example, a person is giving me their property for a 12-year lease. Okay, in such case I will be called the deemed owner of the property. Next, so now we are thorough with the the charging section. Let us jump to the computation section. To compute income from house property, there are certain steps karna. What are the steps? First, you have to compare municipal value and fair rent. Whichever is higher, you have to compare it with the standard rent. Whichever is lower among them will be called as expected rent. This expected rent you have to compare it with the actual rent and you will get the GAV or gross annual value. This GAV, from this you can reduce municipal taxes and you will get the NAV, that is net annual value. From net annual value, you can further reduce section 24A standard deduction of 30% and section 24B interest on housing loan. And lastly, you will get income or loss from house property. Now let us see what is the meaning of these terms. Firstly, what is municipal value? Municipal value means the value of rent that is decided by the municipal authority. Next, sir, what is fair rent? Fair rent, or it is also called reasonable rent. It means the rent of a similar property in the same area. Okay, these two you are only going to compare and you are going to take the higher value. This higher value you are going to compare with standard rent. What is standard rent? Standard rent means in certain areas there is an act called Rent Control Act. Such act will fix what should be the maximum rent in that area. This maximum rent only will be called as standard rent. So the higher of municipal value and fair rent, you are going to compare with standard rent and you are going to take whichever is lower. This lower value will be called as expected rent. Correct? Now this expected rent you will be comparing with actual rent. What is actual rent? Actual rent means rent received plus rent receivable minus unrealized rent. Sir, unrealized rent means what? Bad debts. Correct? But to reduce this unrealized rent, you have to satisfy rule 4 conditions. Rule 4 conditions. What are the 4 conditions? That number 1, the tenancy should be bona fide. It means the tenancy should be a genuine tenancy. Number 2, the tenant should have vacated the property. Okay, if you want to reduce the unrealized rent, you should make sure the tenant should have vacated the property, or if he is not vacating, you should at least take steps for him to vacate the property. Number 3, after vacating him from the property, you should not keep him as tenant in some other property. So tenant should not be occupying any other property of the assessee. And number 4, you should take reasonable steps to recover the rent. For example, sending legal notice, etc. So if rule 4 conditions are satisfied, only then assessee can reduce this unrealized rent from the actual rent. Okay, wow. So now you have to compare expected rent and actual rent. Whichever is higher will become the gross annual value. Correct? From this gross annual value, you can reduce municipal taxes. Sir, what is this municipal taxes? Municipal tax means tax that is collected from municipal authority or municipality or corporation or cantonment board or local authority, by whatever name it is called, the taxes that are collected. Okay, and tax can be of many types: property tax, house tax, water tax, local tax, sewerage tax, drainage tax, etc., garbage tax, etc., etc. All these are municipal taxes. Now be very careful. Municipal taxes can only be taken as deduction if it is paid by the owner. If the tenant is paying municipal tax, you cannot take the deduction. Moreover, municipal tax is fully allowed on payment basis. Fully allowed on payment basis. Fully allowed on payment basis. It means what? If I am not paying the municipal tax, I will not get the deduction. Sir, what if I pay the municipal tax for 5 years? Can I take entire amount as deduction? Answer is yes. If I pay for 5 years also, I can take the entire amount as deduction. So it is allowed on payment basis. Now, in the question, if municipal tax is given in percentage form, then take the percentage of municipal value. Next, so what if property is outside India? Then for that property, for that local authority, if you are paying any tax, it will be called as municipal taxes. Okay. Sir, if GAV is 0, then municipal tax deduction will also be 0. If GAV is 0, you cannot reduce the municipal taxes. Okay. So see here, when I come to this computation, if there is a self-occupied property in Okana, then always, since there is no rent, the GAV will be 0. Okay. And you cannot take municipal taxes as deduction. So there is only one deduction that will be allowed, which is the interest deduction under section 24B. Because of this self-occupied property, the income from house property will either be negative or it will be 0. Moreover, if the assessee is choosing default tax regime under section 115 BAC, then this interest will not be allowed as deduction. Hence, if the assessee is choosing section 115 BAC, then income from self-occupied property will always be 0. Okay. Now let us talk about the deductions, other deductions. Firstly, standard deduction. Section 24A means standard deduction, which is flat 30% of NAV. So take the NAV, take 30% of NAV, it is allowed as deduction. But since this 30% is allowed as deduction, the Act will not allow any other deduction. So for example, if you are doing any repair, insurance, painting or any other carpenter work, anything, any expense that is done on the house property will not be allowed as deduction because there is a standard deduction. Okay. Next, interest on housing loan. It is allowed as deduction. However, this interest on housing loan, as I told you, for self-occupied property alone, it is not allowed in section 115 BAC, that is default tax regime. This you have to be very careful. Sir, what is this interest on housing loan? If you have taken a loan for the purpose of acquisition, construction, repair, renovation or reconstruction, for these 5 purposes, then interest on such loan can be allowed as deduction. Fine. Sir, can unpaid purchase price be treated as loan? Answer is yes. Sir, what is this unpaid purchase price? For example, A has purchased a property from B. Okay, so A has to make the payment of rupees 1 crore for the property. Now what did A do? A only paid 20 lakhs and balance 80 lakhs. A told that please treat it as loan and I will slowly pay you. Okay, so this 80 lakhs is the unpaid purchase price. This also will be treated as housing loan. Okay, and interest on such loan can be allowed as deduction. Next, what if there is a loan taken to repay the above loan? For example, I took a housing loan from Canara Bank, but now I am not satisfied with Canara Bank, so I want to close that loan and take another loan from State Bank of India. In such case, if I take a loan from State Bank of India and repay this loan from Canara Bank, then the new State Bank of India loan also will be considered as housing loan. Okay, or yes, housing loan. Next, sir, can I only take loan from banks? Answer is no. You can take loan from your friends also, relative also, anything is fine. Okay, interest will be allowed as deduction. Next, sir, what is interest on interest? For example, if you have paid the loan late, you have to pay some extra interest or penal interest. This penal interest will not be allowed as deduction. Next, interest is allowed on accrual basis. So this only I tell all my students. Municipal taxes fully allowed on payment basis. Interest only allowed on accrual basis. Interest is only allowed on accrual basis. So for example, if February month interest you have paid in April, then with this February month interest be allowed in, for example, for February 2024, you have paid the interest in April 2024. Okay, it will be allowed in accrual basis. So even though you paid the payment in the next year, still it will be allowed in 23-24 because interest is allowed on accrual basis. Now one special point, if you have taken a loan from outside India, then while paying the interest, you have to deduct the TDS. If you do not deduct the TDS, such interest will not be allowed as deduction. Okay. Now, sir, there are some limits for this interest deduction. What are these limits? Let us see. Firstly, let's talk about LOP and DLOP, let out property and deemed to be let out property. For this, there is no limit on interest. Whatever interest is paid on housing loan or is accrued on housing loan, you can claim it as deduction. But when it comes to self-occupied property, there is a limit. What is the limit? The limit is 30,000. The limit is 30,000. But if you satisfy 4 conditions, you can increase this limit to 2 lakh rupees. Okay, what are the 4 conditions? Number 1, the loan should be taken for either purchase or construction. Condition number 2, the loan should be taken on or after 1/4/1999. Number 3, if it is taken for construction, then the assessee should complete the construction within 5 years from the end of the year in which the loan has been taken. And number 4, an interest certificate should be taken from the loan provider. See, this interest certificate point is there, no Kanna. This point will not be mentioned in many of your questions. Hence, it is necessary that you put an assumption that the assessee has received an interest certificate, and then only you can say that all the 4 conditions are satisfied. Okay, so this you keep in mind. So if all 4 conditions are satisfied, higher amount of 2 lakhs can be claimed as deduction. Now, this interest deduction is there, no Kanna. This is per person. Hence, if the person is having more than 2 self-occupied property and more than 2 loans, then for all the loans combined, the maximum limit will be 2 lakh rupees. Okay, I will give you an example. For example, let's say conditions is there are 2 self-occupied property. Condition is satisfied for first property, not satisfied for second property. Okay, so for first property, maximum deduction can be 2 lakh rupees because conditions are satisfied. For second property, maximum deduction can be how much? 30,000 rupees. But both combined together, can you claim 2,30,000? Answer is no. Both combined also you can claim only 2 lakh rupees as deduction maximum, because this 2 lakh rupees deduction is for a person. It is not for the property. Okay, so this you have to be very, very careful and mark a danger symbol here so that you do not make any silly mistake. Fine. Now, Sir, what is this pre-construction or pre-acquisition period? Let me tell you, Kanna. So let's say for financial year 23-24, the construction got completed on 31 July 2023. Okay, so whatever period is there before the year in which the acquisition or construction got completed is called pre-construction or pre-acquisition period. So when the construction got completed 31st of July, so what is pre-acquisition period? Before the year. So before this point, whatever interest is there will be considered as pre-acquisition or pre-construction interest. Now this pre-acquisition or pre-construction interest will be allowed as deduction in 5 equal annual installments. So for example, this pre-acquisition interest is 5 lakh rupees. So how it will be allowed? 5 lakh divided by 5 is equal to 1 lakh. So for 5 years, every year you can claim 1 lakh rupee as deduction, which is called pre-construction or pre-acquisition deduction. But here also you be very careful. See, this 1 lakh rupee is allowed as deduction. No, this also is included in that 2 lakh rupee limit. Okay, so even pre-construction interest or pre-acquisition interest should be included in that limit, and maximum you can claim 2 lakh rupees only if it is a self-occupied property. Okay, so with respect to 115 BAC, you be very careful. If it is a LOP, DLOP, no problem. But if it is a SOP, then you cannot claim any interest on housing loan as deduction. And also one more point, very important. If you have a loss from house property, you can do intra-head adjustment, but you cannot do inter-head adjustment. In old scheme, you can do inter-head adjustment up to 2 lakh rupees. But in new scheme, you cannot do any inter-head adjustment. Fine. So first you do intra-head, then directly it will go to carry forward. Fine. This point I will again discuss in the set off and carry forward chapter. Then it will be very clear. Okay. Now let us come back to this and let us fully finish off this computation. So in self-occupied property, you can only claim the deduction of interest on housing loan and you will get loss from house property. But if there is a new scheme, that is section 115 BAC, which is the default tax regime, then SOP case, income from house property will always be 0. Then in LOP case, all the figures will be there and you have to do the calculation. But when it comes to DLOP, that is deemed to be let out property, in such case there will be no actual rent. Hence the expected rent only will become GAV. Expected rent will become GAV. Also one more point, Kanna. In question, sir, what if they gave me municipal value but they did not give me any fair rent? Fair rent is not given in question. So what should I do? Then don't consider fair rent. Directly take municipal value in the next step. Okay, sir, I took municipal value in the next step. Now the question does not give me standard rent also. What to do? If standard rent is also not there, then directly take this municipal value as expected rent. Okay, so if any value is missing, then you ignore that step and go to the next step directly. Fine. So this is the basic calculation of income from house property. Now let us discuss all the special concepts. Firstly, let us discuss the concept of vacancy. Sir, vacancy means what? Vacancy means the house property is available for rent, but no one has come and occupied the house property. Okay, that is only called vacancy. So in case of vacancy, what to do? In such case, don't do that expected rent with actual rent comparison. Instead, what you will do, see here. In case of vacancy, you are not going to compare expected rent and actual rent. Then what are you going to compare? You compare expected rent with actual rent plus vacancy rent. Actual rent plus vacancy rent and see whichever is higher. If expected rent is higher, take expected rent as GAV. But if actual rent plus vacancy rent is higher, then take actual rent as GAV. So while comparison, you should add the vacancy rent. But while taking the answer, you take only the actual rent. Okay. So here you have to be very careful. There is a logic behind this also, which I have taken in class, but that I will not be going to discuss here. So when it comes to vacancy, don't do expected rent or actual rent, whichever is higher. Instead, you compare expected rent plus vacancy rent with actual rent plus vacancy rent with expected rent. If actual rent plus vacancy rent is higher, then actual rent is GAV. If expected rent is higher, then expected rent is GAV. Fine. So while comparison, you take the vacancy rent, but while putting the GAV, you take only the actual rent. Fine. Now, so what if there are more than two self-occupied property? If there are more than two self-occupied property, then you have to solve the questions in different combinations. For example, if there are three properties A, B and C, then first assume that B and C are self-occupied and A is DLOP, that is deemed to be let out property. Then find the answer. Similarly, find the answer if A and B are self-occupied and C is DLOP, and then A and C are self-occupied property and B is deemed to be let out property. Then in all the three answers, see in which answer the income is the lowest, and that lowest income will only be the final answer. For this, you will not be able to understand by seeing this video. Only when you are solving that question which is there in the study material, you will be understanding the concept. Okay, so assume all the house properties are DLOP and find the income from house property. Then you have to solve the question multiple times to find which is the most beneficial answer. Now, sir, what if a property is partly let out and partly self-occupied area wise? For example, there is a house property and there are two floors. One floor is given on rent, one floor is self-occupied. In such case, what to do? Very simple. Both floors, you treat it as separate house property and solve the question. So treat each area like a separate property. So you have to divide the municipal value, the municipal taxes, fair rent, standard rent, everything you have to divide based on area. Area basis you have to divide, but don't divide the actual rent, because actual rent is coming only for the rented portion, correct? So don't divide the actual rent and then solve the question. Very simple. Now, what if the house property is partly let out and partly self-occupied time wise? For example, for 6 months it was self-occupied property, remaining 6 months it was let out property. In such case, what to do? Very simple, Kanna. Just treat it as a let out property and solve the question. Done. Next. Sir, what if property is acquired in between the year? If property is acquired in between the year, then take municipal value, fair rent, standard rent, etc. on proportionate basis. Okay, so only for, let's say, if you have acquired after 5 months, then for balance 7 months only you have to take the municipal value, fair rent, etc. But don't divide the municipal taxes, because municipal taxes is allowed on payment basis. So if you are paying even in the last 7 months, take the entire amount as deduction. Similarly, don't divide the interest, because interest is fully paid only by the assessee. So don't divide this interest also. Next, section 25A, arrears of rent and unrealized rent. Sir, what is arrear of rent? Arrear of rent means a disputed rent of the past that is received in the current period. Okay, and unrealized rent means bad debts of rent which is received now. Okay, so recovery of arrears of rent and unrealized rent means there was arrear of rent and unrealized rent and now it has been received. In such case, in the year of recovery, it should be taxed under income from house property if it was not taxed earlier. If it was taxed earlier, then ignore it. But if it was not taxed earlier, then in the year of recovery you have to tax it. Okay. These both are taxable even if assessee is not the owner. So for example, I was the owner of the property in 2021. Okay, that time there was an unrealized rent of 2 lakh rupees. Now in 2024, I am not the owner, but I have received this 2 lakh rupees. Even though I am not the owner, still this 2 lakh rupees will be taxed under income from house property. That is why before itself I told you that arrears of rent and unrealized rent recovery is exception to ownership concept. Okay. Now, sir, how will we tax this recovery of arrears of rent and unrealized rent? Very simple. Take the entire value and you can allow 24A standard deduction of 30%. So the balance 70% will be taxable under income from house property. Okay. And since standard deduction is allowed, no other expense will be allowed, like legal expense, etc. Nothing will be allowed as deduction. Now let us discuss joint ownership or co-ownership. Sir, what happens when more than one person is owner of a same property? In such case, you have to see whether share is definite and ascertainable. Okay, it means what? That you can easily determine what is the share of the different joint owners or co-owners. If you cannot determine the shares, then all the co-owners together will be called as AOP, and the AOP will be taxed. Okay, which I discussed when I told you about holder of impartible estate. But this taxation of AOP is not there in your syllabus. Okay, in your syllabus you have only the cases where the share is definite and ascertainable. So for example, there is a property where there are two owners, A and B, and A is the 50% owner, B is also 50% owner. This means share is definite and ascertainable. You know what percentage is owned by whom. In such case, when it comes to DLOP or LOP, you calculate for the entire property, and at the end you divide the answer in the ownership ratio. Okay, and when it comes to self-occupied property, you calculate the income from house property separately, because both these co-owners will get the benefit of the interest deduction. Okay, for example, there is a house where there is a single house where A is the 50% owner, B is the 50% owner. Sir, if A has paid an interest of 2 lakh rupees and B also has paid an interest of 2 lakh rupees, then how much interest will be allowed? Answer is 4 lakhs will be allowed totally, because A also has a maximum limit of 2 lakhs, B also has a maximum limit of 2 lakhs if all the conditions are satisfied. Okay, in case of SOP. Now let's talk about composite rent. Composite rent means the property is given on rent along with some additional features or additional assets. In such case, you have to ask the question, Kana, is it possible to let out the property without the additional asset? If the answer is no, for example, hotel. In the hotel, when the hotel is giving a room on rent, they compulsorily have to give bed also and other facilities also. Without bed, no one is going to take the hotel room for rent. In such case, entire rent will be taxed under PGBP or income from other sources chapter. But if it is possible to give on rent without the additional assets, for example, you can give a flat on rent to another person without giving them the furniture. In such case, you have to see whether the agreement is separable. It means what? Whether the agreement mentions the building rent separately and furniture rent separately. In such case, if agreement is separable, then the building rent will be taxed under house property and furniture rent will be taxed under PGBP or IFOS. But if the agreement is not separable, then the entire rent will be taxable under PGBP or IFOS. Okay, so this is the composite rent concept. Very simple. Now let us discuss a couple more points. Sir, what if I give commercial property on rent? Is that also covered under house property? Answer is yes. So if I am having a house and if I am giving on rent, that is also house property. If I am having a shop and if I am giving that shop on rent, that is also income from house property. So it does not differentiate between commercial property and residential property. Next, sir, if I am doing the business of giving property on rent, in such case, there will not be any income from house property. You have to see PGBP chapter. This I told you before itself. And then lastly, when it comes to builder, there is a special provision. What is the provision? See here, Kanna. Let's say a builder made a very big building where there are so many flats. Okay. Now, it will take some time for the builder to sell these flats. Fine. Now, till then, these buildings will be house property. Correct? And it will be considered as DLOP, and the builder has to pay tax under income from house property on all the unsold flats. Correct? So now to escape from this, the government has given a relief, or the Income Tax Act has given a relief, that in the years of construction plus 2 years from the end of the year in which construction gets completed, the builder need not pay tax on such house property. But however, after this 2-year period is completed and still if any flat is unsold, then it will be treated as deemed to be let out property and the builder should pay the house property tax. Okay, it will be treated as income and the builder should pay the tax. I think all the provisions under house property are covered. With this, you will be thorough with the provisions, quickly solve the questions, and this chapter will be completely finished for your examination. See you in the next video, dear. Till then, take care. Bye bye.